Okay, with that, I'd like to introduce our first speaker today. So Robert Barr is with Barclays. Rob has worked in IT for 16 years and in financial services for the last 8 on applications ranging from container shipping through medical insurance to stock trading and highly scalable, high-performance trade reporting systems. He acts as the in-memory data grid SME for Barclays and co-chairs the caching, NoSQL, and data management communities of practice. In his spare time, Rob helps kids to learn to code through Coder Dojo sessions and organizes and runs the Docklands branch of the London Java community, a 5,000 plus strong collective of Java enthusiasts from all sectors of development. Please join me in welcoming Rob.
There we go. So thanks, Terry. So today we're going to be talking about in-memory computing and financial services. So there's a few things I'm going to try to cover today. So first, what are financial services and how do they use in-memory computing? Second, what are the drivers for financial services today? And we'll take a quick look at what's coming down the pipeline and where in-memory computing might come into play. So luckily we have 20 minutes for this, so let's get started. Right, so what do we mean by financial services? So there's a number of companies that fall under the umbrella of financial services. Things like accounting firms, insurance companies, stock brokerages, investment funds, credit card companies. But what most people think about, and the area that I work in, is banking. So let's take a closer look at that. So when most people think about banking, they're probably thinking about retail or consumer banking. This is banks that deal directly with individuals. They offer services like savings accounts, current accounts, and they offer products like mortgages and loans. So they help you buy your house or your car or your second house on the lake. We also offer products like credit cards and debit cards. And in more recent years, we've seen an increase in online banking and mobile banking. So banks have expanded their facilities, so you can now do all of your banking on the go. So retail banks have a large amount of consumer data, and they have fairly complex requirements when it comes to in-memory computing. So their use cases range from things like using a cache in front of a database in order to speed up access to your web application, to web session clustering. One more advanced use case that I've worked with is the use of an in-memory cluster as a central collation point. So we have a number of applications feeding into one central area, and we use that as a central point to give us a holistic view of our consumer. Investment banking, which is where I work, is a different kettle of fish entirely. So it's generally divided into 3 parts. You've got your front office, your middle office, and your back office. And the front office is the face of the investment bank. This has a few roles. So there's the investment service. So this helps clients raise money through capital markets. We do things like IPOs and mergers and acquisitions. On the sales and trade side, this is where the traders trade. We deal in a number of products like equities. So equities are stocks and shares which are traded either on a stock exchange or over the counter. We have fixed income products like bonds. We trade in commodities like gold and sugar and oil. We also have money market instruments like treasury bills and mortgages and other forms of cash. We also trade in derivatives, and derivatives derive their value from an underlying asset. So these are things like swaps. So give me some gold, and I will give you some oil. Futures, this is where we're buying and selling tomorrow's product at today's prices. And options, so this is the option to buy or sell at some point in the future. And there's lots and lots of variations on these. On the analysis side, we have analysts that review companies and give advice on whether a particular company is likely to perform well or poorly, and they tell you whether you should buy or sell your holdings in that company. So the front office, again, has reasonably complex requirements when it comes to in-memory computing. For example, we have trading systems that update positions as the market fluctuates. So you want to keep the traders up to date in real time. And this requires quite a hefty amount of in-memory computing power. But the middle office is really where we see the big boys of in-memory computing play. And the two main contenders here are risk management and regulatory reporting. And there's two main types of risk that we deal with. There's market risk, which is the risk associated with changes to market conditions. And this covers things like equity risk. So what happens when the cost of a share goes up or down? What happens if the interest rates rise or fall? What happens if the foreign exchange rates change? What happens if a commodity price changes? And then we have credit risk. And credit risk is all about the risk associated with one or more of the counterparties failing to meet their debt obligations. So we do a lot of calculations around risk. We calculate the standard set of Greeks. So these are vega, which is the sensitivity to volatility, theta, which is time decay, so how much money a particular instrument is likely to lose or gain over time, rho, which is the sensitivity to interest rate changes. We have gamma, delta, and loads of others. One of the most complex things we calculate is value at risk, or VAR, using Monte Carlo simulations. And VAR is really looking at what is the worst case scenario for a given instrument over a given period and with a given confidence level. We also do stress testing. So what happens if the market conditions change dramatically? What happens if the interest rates plummet? What happens if there's a sharp increase in volatility? We also do partial differential equations like Black-Scholes analysis, which gives us a way to value an option over time. And really what we're looking at here is to get an idea of the market conditions, to be able to adjust our market positions based on our current risk appetite. And the back office is where the plumbing of the investment bank is. So this is where finance happens. This is where the operations and technology guys make sure the databases are running, the firewalls are in place, and then the networks are still there. This is also where things like accounting and trade admin happen. And the back office has a surprising appetite for in-memory computing. Our finance systems, for example, although they may not have the same scale as the risk reporting guys, definitely can match them in terms of complexity. Right, so that's the crash course in financial services. Right, so now that's out of the way. Let's take a look at what things were like in the past, what the drivers are for the behavior today, and what might be coming down the pipeline. So in the past, the banking industry was a lot like every other industry. We had huge monolithic applications with silos of data, and these applications didn't really talk to each other. And this led to a lot of duplication and inefficient systems. So for example, we could have trade data replicated up to 12 times. So that's from trade capture onto the legal systems, then onto the front-end risk management systems, the back-end risk management systems, the know your customer trading, the finance, the regulatory reporting. And in terms of projects, long waterfall-style projects that took a year, maybe 2 years, kind of the norm. So things have moved on a bit since then. So let's take a look at what's driving our world today. So aside from our usual competition of other major institutions, we're seeing competition from two new areas. The first of these is new banks. So with changes in regulations and a decrease in the capital requirements, the door has been opened for new banks. Before Metro Bank opened its doors back in 2013, the last banking license that was issued in the UK was 150 years ago. And now we have Fido Bank, Atom Bank, Metro Bank, Starling Bank, and a host of others. So these banks are digital first, mobile first. Sometimes they're mobile only. They frequently don't have a physical presence, and they don't have any legacy tech. And they move fast, and they iterate quickly. So another area we're seeing on the rise is fintech startups. So while these guys aren't fully fledged banks themselves, they look at inefficiencies in the way that financial markets operate and seek to disrupt the industry with new tech. So areas they might look at are things like the processing of payments. So we see Apple Pay and PayPal and Samsung Pay and Android Pay. Investing in financing. So this is driving things like crowdfunding, and we're seeing people like Kickstarter and Indiegogo. And they also move fast, and they iterate quickly. And the agility and innovation of these smaller players are driving the same behavior in the bigger players. So we now have to innovate. We now have to move quickly. We now have to look at how tech can give us that advantage, how we can use tech to keep our market position and gain a competitive advantage. The other major driver we have, of course, is regulatory. And to make a massive understatement, banks are tightly regulated. We have the PRA, or in the UK, we have the PRA, we've got the Bank of England, we've got the FCA. While in the US, we've got the SEC and the Fed. And these are just two countries that a major bank might operate in. We're required to comply with all the regulations in all the regions in which we operate. So there's a host of other regulators out there. We've got MAS, the Monetary Authority of Singapore. We've got ESMA, the European Security and Market Authority, the Hellenic Capital Markets Commission in Greece, and around 50 other countries around the world. And these regulators produced an astonishing amount of regulations. MiFID, for example, which is the Markets in Financial Instruments Directive, looks at transparency in pre- and post-trading. So we're now required to report the price, the volume, and the time of all trades in listed shares, and to make sure that we obtain the best possible execution for every trade. Basel III looks more at the risk of a run on the bank. So we have to make sure that we have enough reserves for various scenarios and be able to report on that to the regulators. The Fundamental Review of the Trading Book, also known as Basel IV, is an upcoming series of proposals looking to harmonize the way that market risk is treated across the industry. So this is likely to lead to increase in the capital requirements and also a massive increase in the amount of data that we need to capture, process, and report on. So really what the regulators are after is they're seeking to increase market confidence, to increase financial stability, to gain a measure of protection for the consumers, and to reduce financial crime like corruption, rogue trading practices. And the consequence of this is generally an increase in the amount of money that we need to have. They change the way that banks are structured and how they operate. And there's almost always an increase in the amount of data that we have to capture and process. So the impact on the tech. So we're seeing large-scale regulatory reporting requirements. We're doing massive risk and analytics processing. And this is driving a consolidation of platforms and a tearing down of those silos, coupled with faster deployment cycles and more agile projects. One of our major computing platforms reported an increase from 40 deployments a week to 400 deployments a week over the period of about 5 years. In terms of architectures, we're still seeing a fair number of standard N-tier architectures. I guess old habits die hard. But a lot of teams are now scaling out horizontally to meet their big data challenges. Our high-performance computing platform, for example, processes about 100 terabytes of data a day and performs around 290 years, I think it's 297 years, worth of calculations on that data per day. Right, so they have a serious big data and fast data problem. A lot of applications I'm seeing are starting to move towards in-memory data grids to meet their performance requirements. So they might start with a simple use case like putting in an in-memory data grid in front of a database to speed up access to their data, and then move towards more complex functionality like parallel processing and aggregation of data. We're still seeing a fair number of physical and physical servers, but there's a major shift towards virtualization in order to make better use of our hardware. Right, so let's take a look at what might be coming down the pipeline. So firstly, we have cloud. Cloud is going to be everywhere. Cloud already is everywhere. And this makes a lot of sense. Financial services aren't really in the infrastructure industry. We don't want to have tens of thousands of servers. Infrastructure as a service allows us to scale up to meet compute demands when we need to, and to worry less about running servers and data centers. Platform as a service allows application development teams to focus more on business requirements and business value, and to worry less about application servers and databases. But cloud does come with its own challenges. So we have a lot of regulators with different levels of sophistication. So we have a lot of mismatched and conflicting regulations. Of course, there's security implications of hosting data like credit card information on the cloud. Some of our code is proprietary, like our quant libraries. So that's considered confidential. So how do we run that on the cloud? And of course, there's performance considerations. If you're running in a virtualized environment, especially one that's not under your direct control. So next up, data science and machine learning. So with the advent of big data and cheap compute, we're seeing a growth in these areas for financial services. So we can use techniques like supervised learning, unsupervised learning, and reinforcement learning to improve the way that we do things like fraud detection, stock prediction. So we can combine what's happening on the market with more advanced techniques like market sentiment analysis by looking at social media like Twitter to get a broader understanding of how the market sees a particular stock. Market trend analysis. So we now have a fair amount of information about the conditions leading up to stock market crashes. If we can replay and compare that with the current market conditions, maybe we can predict and avoid the next big crash. Blockchain. So blockchain is probably best known as the cryptographic ledger, a technology that powers Bitcoin. But the real promise of blockchain is that it can remove the middleman in a lot of industries, including finance. So there's a lot of interest in this at the moment, both in banking and from the fintech startups. And we're seeing new cryptocurrencies being born pretty much every day. So we have RoboCoin, Ripple, Ethereum, my favorite Coinia. And really the promise of blockchain for financial services is that we might see transaction times drop dramatically. Non-volatile memory, or NVDIM, is something that we're hearing a lot about these days. And really the idea is that when you turn the power off, your data stays in memory. So we're already seeing a convergence of relational, big data, NoSQL, and in-memory tech. And as traditional spinning disk becomes less and less relevant for persistence, this convergence is only going to accelerate. On the artificial intelligence side, AI systems like IBM's Watson allow us to augment our own intelligence and to hold more contextual data. We can use things like genetic and evolutionary algorithms to try to better model and predict what the stock market is going to do. But all these techs really have one thing in common, and that's more. That's more computing power, more speed, more data, more and more demand for in-memory computing. Right, so as a summary, so we've had a quick tour of what financial services are. We've looked at the market and regulatory forces driving them. We've taken a very quick glimpse of what might be coming down the pipeline. And to round up, financial services are a complex beast, and they're not getting any simpler. The amount of data that we're processing is massive, and it's never going to get any smaller. And the speed at which we gather that data, analyze it, and report on it is never going to decrease. So all this means more big data, faster data, and more in-memory computing. Thank you.